Real estate investment practice problem using OneNote. Incremental borrowing costs. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon, left-hand side, Practice Problems tab, down in the 6050 Incremental Borrowing Costs tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Presentations, they're also in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, got the information up top, calculations on down below, looking at incremental borrowing costs. In other words, if we have a baseline of borrowing and we were to borrow more money at a higher rate, what would be the incremental cost of doing so? How can we look at that? How can we measure that? How can we make relevant decisions on it? The side-by-side information is going to be, we have the home purchase of the $150,000, comparing putting $10,000 down, putting 10% down versus the 20% down. So if we put 10% down, obviously 150,000 times 0.1 would be 15,000 down, minus the 150,000 would result in a loan of 135,000. If we put the 20% down, 150,000 times 0.2, 20% gives us 30,000, minus the 150,000, we would then have a loan of 120,000. So the question then being, if we have a baseline that we can either put 10 or 20% down, if we had the extra, for example, money, 15,000, in order to make a decision between the two, and if we had the option to do either of them, then what would be the relevant decision to have that incremental increase from one baseline to the next, from a $120,000 loan to a $135,000 loan, with a 30-year being the term, 360 payments. That's going to be 12 times 30 at the rate increase from 8% up to 8.5%. Now, obviously, as the loan amount goes up, then typically the interest rates will typically increase with larger loan amounts generally as well. So you would expect then, as the loan amount then increases, then you have the rate will typically be increasing at some point as well. That then the payment calculation between the two, using the standard payment calculation method within Excel or within a financial calculator, the PMT, that would be the 880.52 for the lower loan amount, the 120, versus the 1,038.03 for the larger amount. So obviously some of the questions we would be looking at here is, well, do I have the option of putting 10% down versus the 20% down? Do I have the $15,000 in order to put it down if I need to under that option? And then we can take a look at the difference between the payment amounts. Are those significant differences to us on a month-by-month basis? In other words, would it be worthwhile for us to lock down, in essence, a lower rate over time to feel secure that we can make the payment over time, even though it may cost us then the more money down, the 30,000 versus the 15? And then we can think about, well, what would be the incremental costs to us to be upping the loan up from 120,000 to 135,000, and if I had the option of taking that 15,000 and either putting it into the loan here or putting it into the down payment, lowering the loan amount, or investing it in some other place, could I get a larger return in some other place? Or possibly, would it be more worthwhile to get a loan elsewhere for a smaller, the smaller loan amount, possibly resulting in lower rates to get the loan elsewhere for that added 15,000. So those are some of the questions. Now we have our amortization tables between the two loans on down below. The larger loan starting at the 135,000, the payments at 1,038 about all the way down, interest calculated at the 8.5 versus the $120,000 loan, payment amount at the 881 about, interest calculated at the 8%. Both of these then, of course, fully amortize after the 30 years. We're deciding between those two options. So if we go all the way down, they will be fully amortized and down to zero at the end of the day, or at the end of 360 days, because that's 30 years and days. Okay, so here we got our comparison up top. Let's calculate the incremental borrowing costs. Some information we're going to need is to take the difference in the borrowing. So the larger loan was $135 versus the smaller $120. That's a $15,000 difference between the two loans. So we got a difference of $15,000. Question is, should we put the more, if we have the $15,000, should we invest it in the down payment on the loan, in the down payment on the home, reducing the loan? Or should we take that money and invest it someplace else to get a greater return? Or if we need the $15,000, should we look someplace else to get another loan for a smaller amount that might have a lower rate? So we have the difference in the payments. The larger payment was the $1,038, as we could see here, versus the $880.52 versus the $880.52. Subtracting those two out gives us a difference in the payments of the $157.52. So in essence, we've got a $15,000 down and the difference in the payments being $157.52. So we're saving $157 or $158 about on each of the payments when we put a larger down payment down, the $15,000 up front. So you could do a quick calculation like this. This doesn't take into consideration, in essence, the time value of money, but you could say, well, I got the $15,000 and in essence divided by the savings I'm going to have on a per period basis, 157.52, and that would be like the payback period in essence. But that doesn't really take into consideration really the time value of money, but it could give you an idea of when these two things kind of even out in the time frame. And then you could take that 95 and divide it by 12 to get the years about 7 to 8 years there. If we're looking for the rate, we can do a rate calculation. And so this is what we really often will be wanting when we do similar kind of comparisons to see whether or not it would be worthwhile to invest some other place or look some elsewhere for a loan. So the incremental borrowing to borrow that extra $15,000, rate calculation looking like this. We'll also calculate this with the IRR, a cash flow calculation, which might be a little bit more intuitive to look at. But the rate calculation would be equals the rate, the number of periods. Number of periods would then be the 30 years or the 360, which we'd get from our data up top, the 360. We then say comma. The payment is going to be, and I'm going to put the negative on the payment in order to get that to populate for the rate calculation. And it's going to be the 157.52, the difference in the payments, because that's what we're looking into or focusing in on, comma, the present value. The present value will be the difference in the loan amounts, which will be the $15,000. We're going to bracket that up and then multiply it times 12 to go from a monthly rate to a yearly rate. And then we get to that 12.279. So again, you're looking at these two rates up top, the 8.5 versus the 8. It went up from 8% to 8.5 to get the loan increased by that incremental amount. But when we're looking at the incremental borrowing rate, we're actually looking at the 12.279. So in other words, the rate represents the real cost of borrowing the extra funds, that being the 12.279. So the questions then would be, could we earn an equivalent risk-adjusted rate of return on the funds that is not invested in the property? So could we take that $15,000 if we don't need it for the loan, for the purchase, if we have the option to put a lower loan or higher loan, should we take that extra $15,000 and put it someplace else and get a return on it? Can we borrow the added funds some other place for a lower cost? So if we're saying, okay, I've got an incremental amount to borrow another $15,000, the question would be, well, is it worthwhile to borrow it, on this loan, or should I go look for a different loan and see if I can get another loan that possibly has a preferable rate given the incremental costs? So we can also kind of look at this and say, well, will that differ if we were planning on moving or terminating the loan, selling the property, for example, in some period other than the full 30 years, let's say 8 years here. So we're planning on selling the property in 8 years. That'll change things up a bit. What we need to know for that calculation will be the ending balance for the larger loan and the ending balance for the smaller loan. So the 123,810 versus the 109,221. You could get these with a calculation. You can also just get them from the amortization table. So if we go up to the amort table at the end of 8 years here, We got the 123,810 versus the 109,221. So that's where we would stand at the end of that 8-year time frame. The difference between the two being 14,589. And then we can calculate using the rate function again, this time adding in essence a future value, that last ending piece. It would look something like this. We'll also look at these in an IRR calculation, but we have the rate. They got the number of periods. Number of periods would be the 8 years times 12 to get it to months, comma. The payment amount is going to be the amount of the payment, same calculation we had up top, which was the 157.52. The present value, we have the negative there in the present value. That's going to be the 15 again, so the 15. And then we're adding now a comma, and we're going to have the future value, which we're adding, which is going to be the difference at the end of the 8 years. That's being the 14,589. That would give us the monthly amount times 12, would then give us the amount for a yearly amount. There's the 12.4. So it is different than it was at the 12.279 if we were only to have it for 8 years as opposed to the 30. Let's look at those concepts with an IRR calculation, which can be a little bit more easy to intuit, I think, oftentimes. So if we have the IRR calculation, the rate at which this series of payments will be zero, we're looking at the cash flow. And that's generally the concept that we're going to be considering here. We're looking at the cash flows. So we have the difference in the cash flows being the 15,000. We're starting first off, not considering the stopping at 8 years, but having the full 30 years. You got the difference between the two loans being the 15,000. We had the 158 then being the difference in the payments that we calculated up top, which was up here. So that's about 158 about. It's rounded to the pennies there. You could think about this cash flow a couple different ways. You could say, well, if I go from a $135,000 loan down to a $120,000 loan, then it would be like a 15,000 difference on the positive, and we would then have to pay an extra 158 basically per payment. You can format it the other way. You'll get to the same basically percentage where you could say, well, if I go from the 120,000 to the 135, you can put the 15,000 as a negative and say, well, that's a higher outflow that you would have, and then you'd have the positive benefits on the payments. So whichever, you'd have to have one of these have to be negative and one has to be positive, clearly. And then if we scroll on down to the number of payments would be 360. We could sum that up. Total flow then of the payments of cash would be 41,706. And then if we were to take the IRR, which is the IRR function of this series of payments, the rate at which this would be zero, then it would be that 12.28 about. So the 12.28 we can calculate this way as well. And that should be the same calculation we got up top. Yeah, 12.279. And then if we were then to do it this way, and we were to say, well, what if we stopped after, what did we say, 8 years, I believe it was? Then we've got the IRR, same kind of thing, 15,000, and then the difference in the payments to 158, but we're going to stop after 8 years. So 8 times 12 would be 96. So if we scroll on down to 96 payments, then at the end of 96 payments, we'd still have the amount that we need to be paying off, or the difference between the two. We calculated that up top, the difference in these two amounts from the amortization table being 14589. So we got the 14589. Then scrolling down, we also have that last payment, or one more 158 that we'd have to pay. So plus the 158, and that would give us our 14,747 at that last period 96. So if we take the IRR there, the rate at which that series of payments would be zero, that cash flow would be zero, would be the 12.4. That 12.4 matching out with the 12.4 we got when we used this calculation up top. So you can see in a few different ways. Oftentimes, especially with these difference kind of calculations, it can be useful to think about what the cash flow would be. That helps you to kind of visualize what you're actually doing here, breaking out, the difference in the cash flows and looking at the IRR calculation, the rate at which the series of payments would be zero.